A story from Reuters this week pointed out the increasingly dangerous lending practices being committed by mortgage lenders in order to sidestep rules put in place by the Canadian government. Mortgage providers are teaming up with rivals who are unregulated and are therefore able to get around them. The result of these partnerships are so-called bundled loans, which pair a primary mortgage with a second loan from an unregulated group called Mortgage Investment Corporations, or MICs. The practice has grown fast because it allows borrowers to make down payments of just 10%, dodging federal rules that require either 20 or 35% down on mortgages not backed by government insurance, according to industry experts. Packaging two loans together allows the regulated lender to skirt those rules. The rise of bundling reflects declining affordability after a long run-up in home prices, and it could present a danger of defaults if prices fall. Such high loan-to-value mortgages are common when housing markets are about to implode, said David Madani, an economist with Capital Economics who has long forecast a housing crash in Canada. He continues, "This is what happens at the late stage of a housing bubble. The quality of lending goes down." This sounds a lot like the practices that were going on in the United States around 2008 when the financial crisis hit. With homes becoming more and more expensive every day, Canadian debts rising quickly and wages going nowhere, the last thing lenders should be doing is making it easier for Canadians to borrow money. But they aren't the only ones to blame. The primary culprit is the low interest rate set by the Bank of Canada. Currently, the interest rate is set at 0.5%, which means that private banks can legally set their prime lending rate at that level. In order for them to cover their costs and make a profit, they add percentage points that they need on top of this to create their prime interest rate. Low interest rates encourage people to borrow money and discourages people from saving, as the interest collected from saving money in a bank becomes so low that savers actually end up losing money, as the rates don't even keep pace with inflation. These incentives put people at a great amount of financial risk. If we look at interest rates set by the government over the last 25 years in Canada, we can see that they used to be much higher, to the tune of just over 4% in 2007. That means that people buying homes now would potentially have to pay an extra 3.5% on their mortgages each month. And if you go back even further, it gets worse, going up as high as around 14% in the late 80s and early 90s. Let's take a look at the math for a moment. The average home price in Canada, according to the Canadian Real Estate Association, is $489,591. If you plan to pay it off in 30 years in 5-year fixed terms with a Scotiabank rate of 4.64%, given that the rate does not change, you'll be paying $2,508.62 per month. That on its own is quite a lot, but if you add even 1% to the interest rate, you will now need to pay an extra $294. How many Canadians will be able to handle this when their debts are already higher than ever? And what if the rate rises 2% or more, or you get laid off? Many will lose their homes, cars, and savings, just like in 2008. Government intervention in regards to the interest rates has created huge bubbles in housing and other areas of business that usually require loans. Left untouched, the interest rate in the free market is like a benchmark that forces people to be responsible with their money if they want to get a loan to buy a home, start a business, get a car, and so on. The lower you set that bar, the less responsibility the people in question must have in order to get their loans. Now that the bar is just 0.5% above zero, it's no surprise that Canada's housing market has become so dangerous. But research into market and business cycles shows that these extremely high demand markets created by government influence always come crashing down, and this one will be no different. This will end up being a very painful adjustment, not only for those who participated late in the cycle, but also for the rest of the taxpayers who have been forced by the government to pay for the mistakes of lenders and irresponsible or ignorant Canadians. Unfortunately, a correction will be necessary if we want a stronger economy based on responsible investment.